I'm Ryan. I'm one of the co-founders of Zerocap. We're a Melbourne-based digital asset technology firm and asset manager. We've got clients in about 50 countries around the world. We specialise in servicing wholesale and institutional clients. And we have partnered with ANZ on this initiative to help them launch a stablecoin. I guess just a bit more background about Zerocap, just for context. So we founded the business in 2017. I myself got into blockchain or crypto around 2016. As Dolly mentioned, my background is as a software developer, which is probably a dangerous thing to say in this audience because it's been a long time since I've been on the tools, so don't ask me any questions about it. But I came to blockchain very much from a technology angle, interested in just distributed ledger technology and all the things that it promised, particularly coming from my background working in financial services and just legacy systems and seeing all the inefficiencies there and in financial markets. But I co-founded the business with two other people that shared this vision of cryptocurrency going mainstream as an asset class. And in particular, we were thinking about the institutionalization of crypto and of blockchain and thought about what would that world look like, and the sort of problems that institutions would be thinking about, things like counterparty risk, AML, CTF, security and custody of the assets, counterparty risk. So they're the sorts of problems that we set about to achieve and to solve rather. And today the business looks very much like an investment banking model that we specialise in digital assets. So there's 3 or 4 core things that we do across the business. The first is we provide liquidity. So we have an OTC trading desk. We do a fair bit of market making on crypto exchanges as well, and we stream liquidity to a few platforms. We provide custody. So for the family office and institutional clients that we deal with, they don't want to manage the responsibility of looking after private keys themselves. Everyone's heard the horror stories of the guy who lost his hard drive and he's digging through the tip, looking for his Bitcoin or whatever. So, that's something that we built out, and we've done that on Fireblocks. I can see some of our friends here in the audience. And the third thing is asset management. So we have a few funds where we actively manage a few different strategies. And we also have a derivatives desk. So we're regulated under an AFSL, we deal in derivatives, and we have a structured solutions desk, which is something that really allows us to alter the risk profile of the asset and do interesting things there. The fourth thing, it really is around technology, right? So when we founded the business, there wasn't a lot of, I guess, credible service providers in the industry. It was a much less mature market. It was basically pure retail speculation. So a lot of this stuff we had to build ourselves. And it's just interesting the way that everything has played out now. Like our original hypothesis around the asset class going mainstream in institutions and all that is obviously, coming to life now. And as it turns out, this technology that we built is kind of interesting and useful to other institutions that now want to get into the asset class. So that's what Zerocap is all about.
Fantastic. All right. So I'm David Buckthought, lead technology for our international payments stream, as well as some of our fin crime around sanctions, AML. And probably don't have as an interesting story as Ryan. So have worked at ANZ for the majority of my career, and payments has been sort of my bread and butter. Bit late to the crypto game, probably a couple of years ago, and it was really geared around sort of the payments industry and what's happening in the payments industry, what was happening with Ripple, how as well, like Ryan mentioned, inefficient our payment schemes were. And it kind of got me to this point of saying, okay, well, what else can we do? I just lived through a real-time payment scheme deployment in Australia, MPP, which cost over $1 billion across the industry. And started going, well, that's great and it's quick and it's transparent and it's everything customers want, but we can't keep innovating like this. We can't keep spending that kind of money. And started to see not just the technology in a distributed way, but the way that the industry was moving in the blockchain world on having development happening across the world. It was sort of crowdsourced development on a lot of the solutions that you'd want to be able to do. So started running a couple of proof of concepts around just intra-entity and how could we use some of this technology for us to clear within ANZ between different geographies. So we have a large portion of the trans-Tasman flows from Aussie dollars to New Zealand. So started looking at, well, what would it mean if we wanted to tokenise Aussie dollars and New Zealand dollars, and whether we solved a problem or not. I think it was really about learning and working out, well, if we can do this in a small scale, what would that mean as more banks adopt, and how do we then start to grow that? At a similar time, much smarter people than me in ANZ, Anurag and Rick Schroeder, from a business perspective in our institutional stream, started really banging the drum. And they had been for a while. They were sort of really early in ANZ saying, guys, we need to be looking at this from an institutional customer perspective. Tokenisation is going to be the new economy. Where are we going to play in this? What does this mean for ANZ? And I can't remember what the scenario was, but we just ended up in the same room together chatting about some of the things that we were doing. And together we just went, okay, well, we could really look at a couple of these pieces and bring it back together and create a real business out of this and really test and learn. And I'm not sure, again, what happened, but sort of at a very similar time, cross paths with Ryan at Zerocap, and one of our customers, the Victor Smorgon Group, who's been with ANZ for a long time. We were working out, they had issues about being able to access the crypto market and the payment schemes, and the amount of time it took for them to move dollars from ANZ through to Zerocap into the USDC market and into the crypto market. And we came together at that stage and said, okay, well, fantastic. We've got a customer. We want to be customer-led. We've got technology that we want to prove out. And with Zerocap as well as a partner going, this is sort of that perfect coalition, and let's just see where it leads. And it's kind of where we got to today. So, yeah, that's a little bit about me. As I said, I was sort of in the banking industry for a long time, and just really want to see where this leads, because I just don't believe in 3 to 5 years' time, payments specifically from sort of my background, but even the way that we do business across our financial products is going to be the same. I think tokenisation is really going to make a huge difference, and banks need to find out where they logically fit in that, if at all. And I believe they do. I believe there's a lot of things banks offer, and a lot of the regulatory imposts that are going to come in over the next couple of years is going to sort of drive that. But I don't think we're going to have that full cake as we did sort of 10, 20 years ago. So just trying to test out some of these concepts, test out some of the customer-led use cases, and work out what is it that we provide that's of value. Because if we don't provide value, the people are going to go elsewhere, and it's kind of just where the industry's heading.
Cool. I think that was meant to be slide 20 that you just talked to there, but that's okay.
I told you I jumped around very quickly.
Yeah. So, like, I guess I'm not going to give everyone a history lesson on blockchain and crypto, but there are a few relevant things to look at here. And the first is just the growth in the digital asset markets, right? So as I mentioned, around the time that I got into it in 2016, it was obviously a much less mature market, right? And, you know, Bitcoin itself has been around since 2008, 2009. But you can see, like, the total market cap really kind of things started to kind of boom around 2017, right? And there's been several booms and busts over the journey. The number of Ethereum addresses has been steadily increasing over time, and now that is actually gaining a lot of institutional adoption. So I would say, you know, like, Bitcoin has been the main asset from an investment perspective from institutions. Certainly that's what we're seeing in our business. But Ethereum has established itself as the de facto standard for that, programmable money, smart contracts layer, and that's what the $8 DC is actually built on. I think something that's really interesting is not just the growth in the industry as a whole, but having a look at proportionally how much of the volume is coming from institutions. So you can see, about 2/3 now of the total volumes across the crypto markets is being driven by institutions. That's in spot markets. The way that we've kind of broken down institutions here is just by trade size. So large institutional kind of, 1 mil plus is the dark blue and the light blue there. And then you've got professional traders and retail down the bottom, right, which is diminished significantly as a whole. The other thing that's really interesting is just the total value transfer, the dollar value transfer in Bitcoin per day. And that's wallet to wallet transfer. Like we're now talking about trillions. So even though the trading volume of the crypto markets is significantly less than that, the actual transfer of value from wallet to wallet on a daily basis has now entered the trillions. So stablecoins is what we're here to talk about, right? So essentially, a stablecoin is a cryptocurrency which has its value pegged to something. And there are a few different kinds of stablecoins, like there's fiat-backed stablecoins, there is crypto collateralized stablecoins, so like say backed by Ethereum or another crypto asset, and then there's algorithmic stablecoins. There's essentially these were created to solve volatility and improve liquidity. So if you were trading on a crypto exchange and you thought that maybe the price of Bitcoin was going to go down, you would otherwise have to liquidate your Bitcoin into a fiat currency, that has a cost, takes time to settle. Then if you want to move back into the asset again, there's a cost and a settlement time there. So stablecoins were basically created so that you could instantly move into a blockchain native asset and retain value, so that when you wanted to move back into your position, you're able to do that. That was kind of the original use case. The first stablecoin which really gained traction was Tether, and that's something that has it's issued by a non-bank, an unregulated institution. Essentially they are able to print as many tethers as they want. It's supposed to be backed one-to-one by cash or cash equivalent products. But there's been a fair amount of controversy around this because the auditing has not been particularly transparent. Where their cash or otherwise assets are held is not entirely clear. And in any case, there's been a few times over the history of Tether where its peg or its one-to-one backing against the US dollar is actually broken. So the whole point of a stablecoin is it's supposed to be stable, right? You're supposed to be able to redeem that at any time for $1. But when the markets have been particularly volatile, and there's effectively been a bank run on Tether, the value of that has dropped away from $1. At times it's been down to 90 cents, even below that a few times in its history. So this, I guess, just goes to show you why there is a need or why there is value in a regulated entity actually issuing a stablecoin.
I think just one of the things why this was important for us is we didn't really see the stablecoin as a way to make money. We saw the stablecoin more as a way to facilitate transactions, which we may make money out of as well. But to have a one-to-one backed stablecoin, you're sitting sort of collateral in an account. You can't do anything with it. You can't enter money markets like traditional banks would with money sitting on their books. But we really did believe that from a banking perspective, if we can provide the capability to hold these stablecoins and use those in transactions, it's not necessarily the stablecoin there that's we're providing value for, but it's more from a transactional side, and we can then start to work with our customers around, well, what do they want to do with that stablecoin? The other unique feature I think that we did around this was opened up sort of an API around the reserve account. So a lot of stablecoins in the industry have monthly audits around the collateral that they hold that backs up their stablecoin, which is great. I think it's a step forwards. One of our sort of takes moving on this is we want to be able to prove on-chain that at any given time, coins in circulation had a direct reflection to collateral held in a reserve account. So made sure that we did have that API offering to be able to real-time call that back. It just creates that sort of safeguard, similar to the Tether story, although there's audits around those, or there is a belief that they're 100% backed. There's still skepticism, and there always will be. So we want to be able to sort of put that to bed as well.
So as I mentioned, like the original use case was really for liquidity and trading on crypto exchanges. But you know that nowadays the use cases have really evolved well beyond that. So it is a medium of exchange, just like any other dollar is, right? But I guess you've got all the advantages that blockchain gives you, like transparency, auditing, near instant transfer and settlement, reducing counterparty risk. You know, you can perform a cross-border transaction. I can send a stablecoin to someone on the other side of the world almost instantly. I don't need to convert that into another currency necessarily, so that you know you're avoiding currency risk and FX fees and all the rest of it. It's actually being used a lot already outside crypto markets. Just like anecdotally, one example of this that I heard the other day was in Argentina, where there are soybean farmers and they need to be paid the buyers want to buy in US dollars, but because of the capital controls which are fairly tight in Argentina, it's very difficult to get US dollars in. They don't want to be paid in pesos because the currency is very weak and not performing very well against the US dollar. So here is a solution where it's very easy to set up anybody with a digital wallet and send them USDC, which was the stable coin that was actually being used in this particular example, essentially in real time. So like these kinds of use cases are kind of growing all the time. A store of value, which kind of speaks to the original use case that I mentioned. So if you want to avoid market volatility or crypto market volatility in particular, you can move your money into a stablecoin to protect its value. It's being used as collateral for loans on decentralized finance platforms. So I think it won't be long before we see this in TradFi as well. Where you can actually provide collateral for, say, a mortgage or something like that. At the moment, the regulated banks aren't accepting that as collateral, but certainly out there in DeFi or crypto land, there are plenty of platforms that will take those stable coins as collateral. And there's also loans being issued in those stable coins as well. And it's essentially become the de facto standard for providing a quote on various cryptocurrencies that are out there, right? So pretty much every crypto exchange in the world is going to have pairs for, say, Bitcoin, Ethereum, whatever other cryptocurrency you want, against whether it's Tether or USDC or eventually $8DC. So these are the sort of main use cases today. We've kind of touched on a lot of the problems and benefits already. Bucky, do you want to kind of maybe give any insights from the bank perspective around, what kind of problems you're looking to solve here?
Yeah, so I think my background is a payments background. And as I said at the start, a lot of what Ryan's business does, even a lot of the discussion around sort of the currency pairs and the ability to do foreign exchange transactions and cross-border transactions, the time delays that that does take at the moment, the markets fees and the currency sort of risks that you play just with having a day delay and not 100% sure what's going to happen in that day and the risk that you're taking along those. One of the things that we really wanted to be able to solve was that speed and that instantaneous knowledge around what it's going to cost, how it's going to get there, and when it's going to get there. The transparency around that. And I think the second thing that probably extends a little bit further past the stable coins, but from a broader industry perspective, is the problems that we're running into around payments at the moment, where it's sort of, it bifurcates. So you always have the transaction on one side and the settlement happening sort of in parallel around the other side. I think what we're starting to see, and the use of the stable coin as that sort of value transfer, is we're able to tie those two transactions and value transfer together, and that's just going to help a lot, not just from the speed perspective, but the counterparty risk perspective as well. So one of the sides of it. I think the other piece as well is we do believe in the tokenization of financial instruments. And we know to be able to do that and then to be able to trade those, we need to have a digital asset that we can use as a value transfer as well. So we believe the stablecoin, because of sort of the risk profile of that, not having the fluctuation risks, and also understanding that it's fully backed and you can redeem it at any stage, it's a great medium of transfer to be able to then enter into the tokenized world.
Just conscious of time, we might rip through some of these a little bit faster. Just talking about tokenization, right? So this is something that Zerocap has a strong thesis around, and we certainly share that with a lot of others, right? We're not alone in this. We see a future where essentially all assets will be tokenized. So a stable coin is a tokenized version of a dollar, but we think that ultimately we're going to see tokenized property, bonds, equity. We've already seen it with artworks, with NFTs and the like, land in the metaverse. So this is something that we're already starting to see play out. And certainly from like our perspective, the kind of conversations that we're having with institutions, the ASX, as another example, they are really buying into this. And I think this is where most of the growth in the industry, the ecosystem, the asset class is going to come from. So I don't think the end game for, say, banks, for example, is like, let's try and sell Bitcoin to our retail customers. It's more, how do we tokenize our bonds or private equity or carbon credits or things that are like otherwise illiquid or difficult to access. And that's where I think the real opportunities are for TradFi. And I know that's obviously where ANZ's head is at as well. So let's just talk about how $8 came about, right? So one of the things that you mentioned was how the conversation started between Zerocap and ANZ. I'm happy to be fairly candid around this, right? So it was last year that CBA announced that they were going to be forming a partnership with Gemini, which is a US-based crypto exchange. And they did actually want to offer crypto trading or investment to their retail customers. And they've run a pilot around that as well. But we figured, well, if CBA is doing this, then all the other banks are going to follow to some extent. And the Victor Morgan Group, who's the customer that you mentioned, they are an equity investor in our business and they sit on our board. Fairly large and reputable family office that's based here in Melbourne. And we got together and said, all right, well, who do we know at the banks? And Peter Edwards, who's the managing director of the Victor Morgan Group, said, well, we've been a client of ANZ for 97 years, so I think we can get a meeting. Sure enough, the next week we were at VSG's offices, and Mark Whelan, the head of the institutional bank, Nigel Dobson, Richard Schroeder, Anurag that you mentioned, like a whole bunch of fairly senior people from ANZ were around the table, and there wasn't really any specific pitch per se. It was more a conversation to say, hey, we're Zerocap. This is what we do. We'd love to hear about where you guys are at with your thinking around crypto and just your digital asset strategy and all the rest of it. And as Bucky said, like ANZ had already been thinking about this and working on it to some extent. There was actually a consortium between the four banks, which the whole idea was that they intended to either launch like a joint stablecoin together or have interoperability between stablecoins, but that had fallen apart. I think one of the banks, it wasn't ANZ, thought that they could move faster, so they pulled out of that and the thing fell apart. So there was already some thinking around stablecoins at the bank, and it was just kind of fortuitous, really, that we came to them. And there was actually a couple of problems that Zerocap was looking to solve. The first was we wanted a bank account. So some of you may or may not be aware, but I guess the banks, given the lack of resources and understanding around crypto, who are just hyper-conscious around AML, CTF, have not been very keen to bank crypto companies. So that's it's quite interesting actually. It's forced a lot of the digital asset businesses in Australia into a very, very small number of what I would call like tier 3 banks that are actually willing to bank crypto companies. And they don't have like the full breadth of services, and it's expensive and it's kind of crap. So that was one of the things that we were hoping that ANZ might be able to help us with. But we also had this client, Victor Morgan Group, a shared client with ANZ. They had a liquidity event coming up from the sale of a business, and they wanted to deploy 30 mil into the digital asset market, so invest across various crypto assets. The way that you would typically do that is, they'd have the settlement from their sale, the money would land in their bank account, they'd have to transfer it across to our tier 3 bank, a bank which doesn't actually support, there's no SWIFT rails to get Aussie dollars out of the country, which is a whole other story. But essentially what that means is for firms like us that needed to get Aussie dollars out, you need to perform an FX transaction from Aussie dollars into, say, US dollars, into a bank account in the US. We would then move it from US dollars into, say, USDC or whatever the various crypto assets are that we wanted to invest in on the client's behalf. Now, that whole process takes days, and there's, fairly, it adds a fair amount of spread into the cost of the transaction as well. So I guess it's kind of ridiculous in a way that we're working with this technology which has all this amazing possibilities and reduces counterparty risk and instant settlement and all this kind of stuff, but we are to some extent still bound by the traditional banking rails. So that was something that we wanted to talk to ANZ about, and lo and behold, they'd already been thinking about that and had a solution. So that was sort of the genesis of how this all came to be.
Look, I actually don't think I've got a huge amount more to add on from that side. I think what we were doing in parallel with that was also exploring what options were out there. And the one thing before this meeting, and probably after it as well, that we really knew is we didn't want to be building technology solutions and then trying to run around and find a problem. We really did want to have customer-led needs, whether it's a 3-day turnaround, whether it's a excessive spread because of the FX and the movements of payments. We wanted to be able to solve customer problems, and we wanted to be able to do it for customers of ANZ because that's the only way that we truly believe that we're adding value. And if we're not doing that, we didn't think we were actually providing much. We're also wanting to experiment with some of the partners in the industry. So I think the other thing that was really important for us through this process, and we'll probably talk about it as we go through the flow, is that we wanted to use this because it was still relatively early in our sort of thinking and our kind of architecture behind it, to understand what is it that we need to play in this game, and do we want to build it because we think there is a competitive advantage around it, or do we want to partner with people? And it was a great opportunity for us to just explore those pieces. And we do know that this industry is moving at such a pace. We can't build everything. We can build pieces that are really important for us in the area of the game that we want to play. And then when we want to partner up, like Chainalysis, I know is here today. Fireblocks guys are here today. So started to go through what's out in the industry and weren't really set in our mind on who and what and why. But with this, not only trying to work out, yes, there is a customer need and yes, we do play a part in that, but also the technology that we want, is Fireblocks the right option? Ultimately, we decided yes, but it was really just testing out those kind of capabilities. So it was a great opportunity, I think, from an ANZ side as well, just to test and learn.
Yeah, I think something else which really helped was we had shared partners and shared infrastructure, right? So we were actually, Zerocap was Fireblocks' first customer in Australia. We also used Chainalysis. So as I mentioned before, like banks are obviously terrified of AML risk. Westpac just got whacked with over $1 billion fine last year. And we use Chainalysis, which is software that essentially screens the blockchain and gives you a lot of insights into the history of that transaction and, has it passed through any nefarious sources? Has it been through, a drug dealing website of the dark web or child, trafficking or any of that sort of stuff. So being able to get those kind of insights and make sure that we're doing our due diligence from a, KYT, know your customer perspective was something that was really important to ANZ. Also the fact that we're regulated as well, right? So, crypto in Australia is broadly an unregulated market at the moment, not for much longer, mind you, but it is at the moment. But we are actually a regulated business because we deal in derivatives and we've got funds and other things that are classified as financial products. But because of that, it means we have to hold ourselves to a much higher standard than, say, an unregulated crypto exchange. And that was something that just resonated with ANZ.
I think, and I don't want to jump ahead if there's slides further along on this one, but I think from a regulator side, one of the reasons why this, again, was pretty important to us and pretty exciting was that we could take the regulators along this journey. So they were in very infant stages as well around what does policy look like around the crypto universe and how do we want regulated institutions or non-regulated institutions to play. What does it mean for someone to issue a Aussie dollars-backed stablecoin? So one of the things that we did very early with our regulators, whether it was through the RBA sort of monetary policy side, AUSTRAC through sort of more of the fin crime side, was to make sure that we kept them up to date with how we're doing it, why we're doing it, what we're trying to learn from it, and sort of the risk profile. We were very contained in terms of this first use case. We kept really tight controls around the environment that we were playing in, but it allowed us to sort of test out and then show to the regulator that you can do this safely if you inherit these kind of controls in your ecosystem. And what we're hoping is over the next 6 months, 12 months, 18 months, as the policy comes out, we'll be able to continue to work with them. And we actually had an influencing hand to play as well at the start to be able to show them how it could possibly be done. So I think taking the regulators along with this journey in such a controlled way was really useful. And I think it will be useful over the sort of coming years as well.
So that first transaction that we ran with the Victor Morgan Group, as I mentioned, was to enable them to deploy 30 mil investment into the ecosystem. Then there was a second transaction that we ran where they actually purchased tokenized carbon credits. So this was really a proof of concept. And I think it's really interesting because carbon credits, it is an asset, or it is one of those markets that is difficult to access. It's fairly opaque. Pricing around it is not particularly transparent either. But here we have something that would typically be done completely off-chain, but the whole thing was done on-chain here. So, demonstrating that we can take, a tokenized dollar trading a tokenized version of a traditional, asset or something that is off-chain. And that whole transaction being completed it took about 30 minutes. In that proof of concept, I think we could probably get it down to 5 if we kind of ran it a few times, right? But Zerocap's role in these transactions is effectively as a custodian of those digital assets. So as I mentioned, we use Fireblocks technology for private key management, and we built our own custody solution around that. And we're a market maker as well. So, at the moment, if you're holding $1 you need to find someone that's going to accept it, right, or build a market on that, and that is the role that we played in that transaction. How are we doing for time, Dolly? Yeah. Okay. I think we're almost done here anyway. I don't want to steal your thunder here, Bucky. If you want to.
Yeah, I think we've probably covered quite a bit on here as well. But through the benefits, I think where we're starting to see more and more come into play, and I'll have a chat about security and risk in a sec as well, but the reduced FX risk, the reduced fees, the duration, I think all tie quite nicely together. As you start to reduce the counterparties in a chain, you reduce the time, you reduce the fees, you reduce the FX risk because you've got a much better settlement mechanism. I think the bit that interested me, and I mentioned it at the start, but with Ryan's commentary around the carbon tokenization and the trading across that, it sort of sets a bit of a blueprint for us now, and not just ANZ, but from an industry perspective, a Zerocap perspective around what does it mean to tokenize these traditional financial products. And the time delay that we're seeing in it, I think trade finance is sort of really ripe for the picking in this space, that it's so manual. Every verification is done via paper. It's then sent to a legitimate auditor who charges a fee along the way as well. You can now have this all done on chain. And in a matter of seconds, you can have sort of off-chain API calls through Oracle directly on there. It's now irrefutable. And all of those benefits then start to come into play. The other bit, not specifically around security and risk, but probably more the financial crime side of it. I've never seen our financial crime or financial intelligence team so excited about the data that they get to now see. They sort of... Traditionally, they're just running big data stores, pulling them off any database they can, or uploading screen scrapes and trying to make sense of it. The one session that we had with our financial crime team and chain analysis in the room about being able to track the movement of some of these coins, and then also the data that we can show around what wallet addresses have been involved in what activities across different networks is amazing. And I think it's something that, as the regulators and as the financial institutions start to understand more and more about, they'll start to realise that we're actually getting a lot more of a data-rich environment where we can control our sort of risk profiles a lot better. It's not a scary dark world that we don't know what's happening. And just because you don't know a name attached to a wallet address, if you've got partners from exchanges, trusted partners that you'd bank, you can then work with them really well, and you can work with the sort of feds around, well, what does that mean? How do we link those back to customers, and how do we create that safe environment? So I think it's been amazing over the last couple of months watching those teams just go, you can show me all this. Like at the moment, it leaves ANZ. We don't know what happens to that Aussie dollars. As soon as it turns into cash, we don't know where it's gone. As soon as it goes overseas, we actually don't know the details around that. This is a new world that you can actually then continue to follow it. It does beg the question, at what point are you now still liable? Like if it's 2 hops down the chain, just because you can see it, are we still liable for it at that stage? Or if it happened 2 hops before it got to ANZ, at what point does our responsibilities end? And I think this is where we're hoping sort of for policies to come into place to help guide us around that.
Yeah, and I mean, just quickly on the regulatory side of things, like this is moving really fast. So over the last year, we've had ASIC, the Board of Taxation, Senator Bragg, and through Parliament, And now the RBA all having consultations with industry on how they think the industry should be regulated. And it's great that they're actually involving us in the conversation. And I can say, like, from what I've seen, or the conversations that we're having, like, broadly, it looks pretty good from a regulatory perspective. Like, it doesn't feel like it's going to stifle innovation or make it really difficult to access the asset class or the ecosystem. I think what we'll probably end up with, like, just kind of riffing on what you were saying there about sort of the financial crime team and the data that they've got access to, I think we're probably going to end up with like a dual ecosystem where you've got centralized and decentralized services and service providers. And essentially, like, you as the investor, the user, whatever, will be able to choose which one of those ecosystems you want to play in, or potentially even move between them as well. But even looking at like regulation globally, what's happening in Singapore and in the UK and elsewhere, it doesn't look overly restrictive. So I'm not too worried about that. I think that's all we wanted to say. Thank you. Yeah. We actually have. So we've been working with them to help understand the risk, basically. So it's been a bit of a journey, but I think all the banks are changing their attitude on this. Yeah. I mean, my view on that is, it's got the largest ecosystem. As I mentioned, it's basically the de facto standard, right? And most other layer one blockchains are EVM compatible anyway, like the Ethereum virtual machine. So if you write a smart contract on Ethereum, that's going to be more or less compatible with other blockchains. Also, I mean, I guess access to talent and developers and that sort of thing is important as well. And I don't want to put words in your mouth, but I think also just like doing something different, right? So, we kind of touched on Ripple, I guess, was where the banks were, or institutions were originally looking. Hedera and other sort of private permissioned blockchains have been working with institutions and banks as well, but this was the first bank-issued stablecoin on a public ledger, public permissionless ledger, right? So I think that was important too. Yeah,
I think one of our thought paths behind this was probably just the EVM compatible side of it, not necessarily Ethereum. We've also deployed on Hedera as well. And this personally, I think there's two pieces in my mind. I'm probably not smart enough and I don't have the foresight around where the industry is going to land and where the winners are, but I do think it's going to be in that EVM side. So whether it is Ethereum, whether we're running on Hedera, I don't know, but I do believe the community and the amount of development that's happening around Ethereum is just far and beyond anything else. So I do think that's where we want to at least be targeting. And what I also believe is that we're going to run a bit of a horses for courses kind of setup in the future as well. So we're running a couple of use cases on Stellar at the moment to prove out some of our payment use cases. So not necessarily will end up as a Ethereum only shop. I think depending on what that use case is, where the industry lands with that sort of piece, it will dictate where we want to be. We want to be chain agnostic as much as possible, but also wary that we don't want to create a smart contract for every different network out there. So kind of led us to EVM.
Look, I mean, Ethereum, I guess we've had ANZ rather, had the smart contract audited by OpenZeppelin, which is essentially the, again, sort of the de facto standard or one of the premium partners for auditing smart contracts, and really went above and beyond to get a perfect score on the audit there. And, I think making sure that we're investing, as partners in building out the team that's monitoring, developments in the blockchain and making sure that we're constantly auditing and staying ahead of the curve is something that we've been really conscious of. And
and I think as part of that smart contract, so within the Open Zeppelin audit, there's a lot of capability that you need to be able to have built in to be able to score really well. And a lot of it is around the ability to pause, the ability to retrieve back sort of stolen coins. The use of Fireblocks as well is something that's pretty important to us around the security standards that they've got every time that we transact through them onto the chain. We honestly have started off relatively contained in sort of the sort of profile around how we interact. We're running a whitelisting capability at the moment, which probably isn't scalable, but it has reduced what that risk profile is. I think what we want to do is, as we continue to build it out, as we continue to widen that net, to make sure that all of those kind of risk profiles are built in, the security standards are built in. The smart contract itself, I'm not going to say is flawless, because I'm sure in years to come there will be holes found in everything. But we did put a lot of effort in. We didn't want to run a proof of concept that just showed that we could do it, but it wasn't industrializable or wasn't scalable. We wanted to make sure that it was secure. We wanted to prove to regulators that this isn't just something that we knocked up really quickly and look, we can deploy on chain, but it's something that helps guide the industry. So security is massive for us. Not to say that there won't be attacks in the future, not to say that even in our traditional finance that we're not finding them as we go, but I think it's just sort of playing it as it comes.
Yeah. So I guess what you're saying is like with the smart contract, if there is an attack, there might be a notification or something.
Yeah, we've got a lot of sort of observability around our coins on the network and what's happening there, and we've got a lot of safeguards within the smart contract itself to be able to then pause those coins or retrieve those coins, burn those coins. And at the moment, also the redemption needs to happen through ANZ. Now, that's not a long-term game. Like, we know that's not scalable, but at least there was that added safeguard as we sort of progress forwards.
Yeah, sure. So from Zerocap's perspective, so we've been engaged with the RBA. They've at the moment they've invited industry to submit potential use cases for a CBDC until the end of this month, and then I think they'll take a month to kind of deliberate on those, and then there'll be a handful that are selected to participate in the pilot program over the course of a 4-month period. So we have a bunch of ideas for how we would actually use a CBDC ourselves, but it's been really interesting just to see how it's kind of catalyzed, the industry for traditional finance, particularly banks, but also the more digital asset native businesses like Zerocap to actually collaborate. I don't think the CBDC is going to completely eliminate like the use for a bank issued stablecoin, and like the DFCRC, who's running this pilot program on behalf of the RBA, like they've been pretty clear that they want to see use cases that could only be solved by specifically a central bank digital currency. So if it's something that could be solved by a bank issued stablecoin or a non-bank issued stablecoin, then it's not a real use case for the CBDC, and therefore it shouldn't.
Wholesale versus retail.
Yeah, that kind of thing, right? So I guess we'll know more at the end of November when those use cases are actually selected and announced. But yeah, as I said, like it doesn't sound like it's going to eliminate the need for bank-issued stablecoins. If anything, we might see that bank-issued stablecoins are actually collateralized by the CBDC rather than being collateralized by deposits or, fiat reserves in the bank or something, potentially.
Yeah, I think my view on it is it's fantastic because it's just going to drive the industry forwards at a greater pace rather than ANZ, or if NAB then comes along, or Combank, Westpac, whoever, with their stable coins and comes out with these use cases. It does make a step forwards, but it doesn't have the same impact as the RBA coming out with the CBDC sort of pilot and saying, okay, well, what does the industry think? How do we move with this? All I see is positives coming out of it, that it's really going to force policy, it's going to force the industry, and it's just going to help us move at a greater speed.
Yeah, the other part of your question was around the ASX, right? So we've been working with them on this for a while now, but they're thinking about essentially turning themselves into a digital asset exchange, and not just like crypto, but as I mentioned, tokenized assets, right? As you mentioned, that platform, the Symphony platform, uses DAML. They're going to need some kind of tokenized asset as a settlement, or tokenized dollar as a settlement mechanism, kind of within that infrastructure. So we could, and we have, bridged other crypto assets into the platform, Bitcoin, Ethereum, other stablecoins, but it might end up being a CBDC potentially. There's certainly a strong use case for the ASX because under the sort of regulatory regime that they sit under, they have to use a central bank issued money to settle trades, like on the chess platform, for example. So that might mean that they have to use a CBDC. And maybe that is the only use case, I don't know. But yeah, anyway, that's where it's at. I think we'll end up, as I mentioned before, like I think we'll kind of have this dual ecosystem, right, where you've got centralized and decentralized services and assets and liquidity and whatnot. So I think that markets will be made on all of these assets, right, and they'll essentially be interoperable. So I don't see one as a threat to the other, and I don't think that one blockchain is going to win out over all the others either. Like I think it'll be multi-chain, there'll be bridges, we're going to have redeemability or interoperability between these different assets.
Yeah, so yes to the first part. I do believe we're going to get to a point where they will be freely traded. Where we're at the moment from an ANZ perspective is really targeting in the institutional use cases. So having the stable coins being used to facilitate other institutional needs, but there is no reason why we wouldn't allow then markets to be made around these and then trading back and redemption back into Aussie dollar fiat. From the second part, I got to admit, the risk associated with multi-chain, it's probably a space that we haven't explored to enough of an extent to understand, okay, well, once this does get out into the open and we are running a more blacklisted capability and any new wallet address can trade over these coins, where does that lead us? What does our regulators say about that? What does our fin crime teams look at about that? I think a lot of this is still work in progress and probably something that we're going to start seeing over the next 6 to 12 months around what the views are from financial institutions as well as the regulators themselves.
Great. Thank you so much for that, guys. It was very insightful. I've learned so much. I'm going to pull you up on a couple of questions afterwards when we're having refreshments. What I would like to do is also give you a little gift. And thank you for your time.
Thank you.
Thank you.
Thank you very much.
Good on you, Dolly. Thanks a lot.
Thank you.
Thank you.
Thank you.